Hello, everybody, and welcome to Masters of Real Estate. Today, I have a good friend on the call today, Anthony Walker. Really appreciate you coming, man. It's always great to have you because you have such a breadth of multifamily experience, and we have our friendly banter about me hating California and you loving California's real estate, and everything. And we've had some good discussions with it in the past as well, and we'll probably talk about it some more as well. But thank you so much for coming on the call. I really love having your knowledge base when it comes to the economic side, when it comes to what you see out there in the field. You run both the brokerage side as well as are an investor in multifamily yourself. So you kind of come with that unique experience. You see what you're doing and what makes a good deal, but you also see what everybody else is trying to sell and, throw on the market right now too, and get a gauge for what other things are closing for. So it's a good place to start. And, if you could do California real estate and make these numbers work, then more power to you on that stuff. It's a hard thing to do in today's environment. So can we talk a little bit about your background and experience in real estate, how you got started in real estate, and go back to the childhood, man. I want to see what you're really made of. So
first of all, thanks for having me back again. Always a pleasure, Matt. I love catching up with you. Wow. Yeah. Going back to the beginning. Well, I wasn't born into a real estate family. So that's different from a lot of people's background. And actually, this is my second career. So I spent 10 years as an insurance claims adjuster and claims manager first, and decided I didn't really want to do that for my whole life. So I went to business school. That's where I discovered real estate. But what I do remember about being a kid as it relates to real estate is my dad was a bankruptcy attorney. And so, I was raised to believe all debt is bad, right? And if you can afford it, you should buy it cash. Obviously, that's not what typically goes on in the real estate investor's life. And the other impactful memory I have is he had a client that paid him by giving him a duplex because he didn't have any money.
Interesting.
And he took the duplex. This was in St. Paul, Minnesota. And this was in the 80s. And I still remember on Saturdays going to the duplex and waiting in the car while my dad had to go in there and try and fix an appliance or collect rent or something like that. He hated that experience so much, he vowed never to be a real estate investor. So of course I became a real estate investor years later. I did eventually get him back on the train, but now with professional management to handle the rentals out here in California. So we're doing it.
Awesome.
But yeah, as far as how I got into things, I went to business school to figure out what to do with myself coming out of insurance, and got introduced to Buckingham Investments in around 2010. So really interesting timing. I'm sure we can get to this in a minute too, but the environment then was a lot like it is now. It's very challenging,
right?
Tough to get financing. Values had, cratered over the last 2 years because of the subprime crisis. And initially I was an investor. I was a client, Buckingham Investments. So local brokerage here in the South Bay, LA area, Southern LA County, Northern Orange County. Bought a couple properties just to get started. A little duplex, a 5 units, like a rental house. And then, I met a group of guys and we were kind of all trying to get a portfolio going together.
Okay.
I think there were 7 of us. And
support group is important, man, for sure.
Yeah. So I partnered with them. They had some more experience than I did at that point. And we did some very small little fundraisers back then, 2010, 2011, 2012, to buy some small multifamily and medium-sized multifamily, mostly in Long Beach. And then along the way, I got my real estate salesperson's license. I joined Buckingham as an agent, and then used that to sort of scale up my own portfolio, help clients start to, build some real estate wealth along the way. And then, here we are 15 years later. I've got a pretty good sizable portfolio of stuff. Mostly I invest on my own account, although I've done some partnership deals, and syndication deals as well along the way, done some fundraising, been the operating partner on some of them. And so it's interesting to kind of see us come full cycle here and be back in the downturn and trying
environment, right?
Yeah, help clients navigate it and do the same myself. As you mentioned, I buck a lot of the trends in that I invest right here in Southern California. I think it's great. And it can be challenging, but if done right, you can do really well.
I think the most important thing I got out of that was that I need to start charging my clients in real estate instead of making them pay for tax services and other consulting stuff. So that way I can just get the real estate instead. It all started with that, man. There you go. So just get paid, and maybe some Bitcoin too. I'll start accepting Bitcoin as well, right? So just as a hedge. So that's really interesting story. You know, I actually had a little bit different experience, but also came from the CPA background where that was my career. It's totally, you know, non-investment related. Most CPAs don't have that detailed knowledge about investments. They're not taught that side unless they actually have clients that are specifically working in that aspect, and they may not ever see it from the investor side of things as well, right? And being able to transition into real estate in like 2006, I thought I was a genius and realized I wasn't a couple years later, of course, and had to go through that same type of downturn where you're able to see what's happening, you know, and the similarities in the market. Back then, it was a very big liquidity issue. There was not a lot of financing available, right? At that time, it was tough to qualify. Things weren't penciling. It was a down market. Everybody's afraid of real estate. It's hard to raise money, right? But that was a major mortgage crisis that occurred. Now we had super low interest rates, and then everything just switched on us, and now nothing pencils anymore with regard to financing, or a big chunk of it doesn't, unless you're going to do a major value add to improve that value, which a lot of is picked through now, of course, as well, because through low interest rate environments, people are picking up properties all over the place for, you know, higher prices than they would normally pay because the interest rate environment at that time. And, you know, you can see right now things got, you know, hit, especially on, I'll say, the commercial side, because they're so driven by those rates that it becomes very difficult to actually make an investor happy with the return now. And so what are you seeing out there right now as far as how people are getting deals done? Is it just that value add component? Are they being creative right now with being able to find deals? What are you seeing is working? And I'll say kind of a broken real estate market because sellers haven't come down yet where they need to be compared to pricing or where it should be, right? So
yeah, we're back to where we were. You know, the income metrics now are kind of where they were in like 2013 and 2014 for commercial multifamily. Definitely a tale of two markets. You've got the like small multifamily 2 to 4 unit stuff. They all have 30-year fixed financing, so there's that lock-in effect that you're experiencing in the single-family space going on there as well. Those deals are very hard to make work because there's no pressure on the sellers to sell. There's no distress there.
They got long-term debt. They can ride it out if they wanted to, right? So, and their rents are going to rise slowly over time. So,
inventories remain low there, and pricing has not gone down much there. Totally opposite scenario in 5 and up. 5 and up, obviously, you've got the commercial multifamily debt that's typically balance sheet loans, at least here from, you know, the banks, mostly, not as much agency debt here, although we get some of that. And those loans reset. They get adjustable every 3, 5, 7 years. Everybody loaded up on the super low stuff in 2020, 21, and 22 with a lot of 3-year and 5-year money because that got you the most leverage. So those resets are happening right now. We're hitting the wall of maturity, so to speak, really last year, this year, and next year. And so we're seeing the damage from that play out on, at least here locally, on buildings. If they had the same rent roll that they had in 2022, they're down 25 to 30% in pricing here locally. So it's a huge change. Cap rates have gone from 4 to basically 5.5 or 6.
So it's super important to make sure you're raising rents consistently on your units right now, because you definitely took a hit on value if that's in the meantime.
Yep. So deals are staying alive if sponsors or investors were able to keep up to date with their rents. But there's some forced selling happening now too, because those loans are resetting. They're not hitting debt coverage ratios for a refi. Investors don't want to do a capital call and put, you know, new equity into a deal that's going to be single digit returns. So you're seeing forced selling, inventories risen. So then to answer your question on how deals are coming together, you know, finally after 3 years, the price discovery has happened. The expectation gap has really narrowed here. Pricing is way down, and the reality check is real for sellers that are dealing with that, and they have that impetus that they have to make a move because all of a sudden their payments have doubled or even almost tripled in some cases. You know, I'm seeing deals like sell even in the 9s on GRM and the 10s, which is crazy. I haven't seen that since I was early in my career. Cap rates are almost even with the cost of funds right now. So you know, 5.5, 6, even low 6 on cap rates, and you can get debt in the high 5s or low 6s depending on the level of leverage. So investors, if you have deals that have upside, or you have the ability to, you know, shave off expenses or build ADUs, which is still super popular here, that gets people interested in the deals. I think there's a general consensus finally just now in 2025 as well that we are kind of at the bottom that we're at the belly of the market and that cap rates have pretty much topped out, and we expect this to, at least achieve equilibrium now and kind of come back down
Right.
from there. So there's starting to be investors that are willing to jump back in and make acquisitions. But yeah, to make that happen, all of a sudden, I'm seeing seller financing back in the mix. Bank debt it's there. There's money there, but it's expensive.
Right.
I'm seeing creative partnerships happen once again. What I'm not seeing is what you mentioned earlier. It's very hard to put together a syndication and promise like a short run 3-year IRR that looks good at all. You can't assume that you're going to exit with a lower cap rate than where we are right now. And so that's caused a lot of people to kind of not be able to do deals the way that we have been the last 10 years.
That makes a lot of sense. And you're saying you're seeing a little bit more stable environment right now with sellers and buyers seeing eye to eye on some transactions, but there's no guarantee or even thought necessarily yet that interest rates are going to come down. Yeah, there's administrative pressure, to do that, but they don't control that. And so at the end of the day, it's more tied to the 10-year. And right now, it doesn't seem like, Powell's coming down on rates anytime soon. And he's just kind of hanging firm with where we're at. And so, at the end of the day, this may be new reality, right? Where you're going to have to come in and, maybe there's some good sellers out there now that are, in the stress enough to be able to actually do some trading and some transactions that are occurring. This is, in California is a tougher market because you have a lower initial cash flow, but you've also, you schooled me in the past on the benefits of California real estate where, the government entities out here, the rent control things they do, the different regulations they put in place really limit supply and continue to push rents up as well, which long term, if you're able to weather that storm, it's maybe you can do some conversions into fourplexes and get 30-year fixed rate money again and buy down the rates, or something. But these are the things that you have to do to try to figure out how are you going to make this cash flow in the meantime and take that lower level hit so that you can have that, long-term rent growth, into the future, right? Because really the rent control stuff pushes rents up further because people don't want to be left behind, right? They don't want to be stuck with low rents and then never be able to raise them.
That's right. I think the inclination is when you hear about when you hear about rent control as an investor is to think I'm never going to be able to get there. And because this, added level of regulation is present, I just don't want to invest in the area. In reality, we know rent control doesn't work. It doesn't help the people that it's supposed to help, but it exacerbates supply problems. And it makes rents for new tenants even more expensive when they go out to rent something. So you have to be more patient in these markets. It takes more money. You have to accept low cash flow in the meanwhile. But that's absolutely what we see happening. There's very little land to begin with to add additional density. The NIMBYs are perhaps as powerful here as they are anywhere in the country, which, unfortunately goes to the incumbent landlord's side of the table because we can't really add any additional supply. And so that's a recipe for really great rent growth over time, even though you might have rent caps on the buildings that you already own. And if you're careful and you buy in areas where we only have like the statewide flavor of rent control, you can get pretty good rent increases. Like right now, you can take an 8.9% increase, which is honestly enough to keep up with market very easily. And yeah, like you said, I think we're going to be the benefactor. We already have been the benefactor where other parts of the country have seen a huge wave of supply hit over the last 2 years. We have not. If you check CoStar and you see sort by vacancy rate of all the largest markets, you've got New York City and then you've got Los Angeles. That's it. And Orange County. So other than New York, whose vacancy rate is like 3%, ours is, I think, about 4.8 right now, as compared to a lot of other markets that are in the 10s, 11s, 12s, even 13%. So the fundamentals here are actually really strong. And I think the long-term economics are definitely in the favor of people who own here. And this is a great chance to get a low basis for property that otherwise in most, segments of the cycle would seem just unattainable for most people.
It's all going to depend on gas taxes and how many people exit California from Newsom's policies. So we'll see how he does. Maybe one day
to really move the needle.
maybe one day he'll complete that bullet train. We'll see what happens.
It's all
the
going
wishful
in
thinking.
Pockets first, I think.
Right, exactly. So, it's an interesting, piece. What are some of the differences between, hey, we had this downturn in 2008, right, through 2012, and we went through a good buying period where we had, long-term, bull market for years, and then now we have taken this kind of hit where you're seeing some distress because people can't refinance at those same rates, and they're going to be forced selling. Otherwise, they're going to be doing capital calls to bring more money to the table because they're over leveraged because those rates went up and now they can't refinance for the same prices. But obviously last time it was more of a, liquidity issue. Right now, it's more of a change in actually what the mechanics of multifamily are based off of, right, on those rates. And what other changes or things are you seeing along the way? And how was it different in like the good times in 2000, I'll say 13 on, through that bull cycle?
Yeah. So, this time around, generally there's a lot more equity in most deals going into the downturn, right? Their leverage was way higher in the subprime boom. And so when it hit last time, I mean, you were there. It was all short sales, REOs.
Right.
And it was actually led by the smaller properties, right? It was the 1 to 4 unit properties that caused most of
the biggest hit.
And unfortunately, it hit the middle class, it hit homeowners, and it hit kind of Main Street. This time, the distress is firmly in the larger commercial real estate deals. But to begin with, they've been doing debt coverage ratio underwriting forever. Although you have forced selling and distress happening right now, there's enough equity in those deals that I haven't seen any foreclosures or, short sales going on. There's still equity in those deals. Investors are going to lose money. They're going to lose principal when those sales happen if they don't do a capital call. But what we're not seeing is a whole bunch of bank-owned assets. That's totally different. And to your point,
investors are going to get some money back on these things. They're just not going to get all their money for the most part in these types of situations.
Right. So these are going to be market sales. They're going to be bigger buildings generally, but bigger starts at like 5 units. So it doesn't have to be huge.
Right.
And then I think what you said it right earlier is that we have to be expecting that we're going to be in a higher for longer interest rate environment. The subprime crisis really forced the hand of interest rates to be on that steady downward trajectory for 15 years, pretty much. Mm-hmm. And this time, I'm not confident that that's going to happen again. I mean, maybe a recession is in the offing. That's what we were worried about the last 2 weeks in the stock market, kind of crashed. Now it's good again. And, Jerome says everything's fine. And next week it'll be something else, but that hasn't happened. The GDP hasn't really taken a huge hit. The consumer seems to be doing okay. Unemployment is relatively low. So to that point, it's a microcosm within the commercial real estate industry and within each region that's experiencing things differently. The capital structure is broken because rates are so much higher, and cap rates that investors are demanding are so much higher than they were. And these buildings can't be refinanced, but I think there is a market mechanism that's going to work this through the system. Unfortunately, it's kind of I don't want to say it's healthy because people are going to lose a lot of money, but it's a necessary part of the cycle that
you need a correction.
You have to have a correction to work this way through, reset the expectations for yield. I mean, when you really look back at 2021, and you're penciling deals at a 3.5 or 4% cap rate, like from there, it gets so thin. How do you model things appropriate on the exit? How do you deliver yield to investors? So it's painful today, but I think if you focus on yield and the value add is a bonus, and you look at supply and demand metrics really across the whole country, but here too, we're setting ourselves up for another, I think, long period of probably gradual improvements as everything equals out. We achieve a new equilibrium, and cap rates can gradually come down as people kind of calm down and get back into it.
I pretty much agree with that because I see things going sideways for a long period of time just because I don't see rates necessarily coming down, and I don't think we're necessarily historically low in interest rates. No. Yeah, in the last few years we were crazy low, but that was the lowest ever in history, let alone, if you look at the averages, we're still low compared to the averages. And so, what does a healthy market look like? We really don't know anymore because of the amount of money printing and, the amount of corruption within the big banks and, the mortgage business and things like that, of course. But at the end of the day, I think there's good financing that occurred over the last 10 years or so. After that big crash occurred, they at least kind of woke up and said, wait, let's not do this stupid. I know they're still doing the whole equity swaps and stuff like that right now in different names, but we'll see how much liquidity issues that comes. I have a fear of the commercial market challenges having an effect on the banks. And, what it sounds like is that, that might be minimal. They might be able to work those things out as far as major distressed situations and foreclosures coming back. So that may not necessarily affect the banks as much in those situations if they're able to go and do workouts and that kind of stuff, which I think would happen a lot more in the commercial space than it would in the residential space, like in 2008 anyways. before they even knew what the hell a workout was, I think. So
It's a great point. Yeah, I think it's a testament to lessons learned from the last crisis that we haven't had systemic-wide bank failures. I mean, we had the stuff that happened in 2023 with First Republic and
right.
SCB and all that kind of stuff, but that was kind of isolated. The banking system seems to have moved beyond that. Balance sheets are relatively healthy, and to your point, like there's been some extending and pretending going on and workouts and modifications, but people are making the payments and they're finding a way to make this work. And if you're a bank and
Right.
that's happening and you're getting decent yield on the notes and they've already reset and you underwrote them well to begin with, I
Mhm.
think it shows that maybe we did some things right on the way into this. The fact that we've been able to withstand this, what's really been an insanely rapid rise in
What is
rates
that, a
with
20%,
yeah
30% correction in the market because of the rate changes?
yeah,
I
and
mean,
we're not looking at widespread contagion, so the
right.
fact
That's
that that's
insane.
happened is probably good for, what we've done in response to the 2008 crisis. It definitely hurt some investors.
Yeah. Yeah.
But I don't see this spreading, to a whole new financial crisis. I think if it was going to happen, it would have happened in 23.
And I think I see a lot of investors right now that don't necessarily understand this. The limited partners that invest in people's funds, I don't do a lot of multifamily other than smaller fix and flip type projects and things like that. I invest passively in these opportunities as well. And I've taken some hits on my investments with other operators that, had
Yeah,
adjustable rate mortgages or had issues on the back end of this because we just bought at the wrong time, right? If you
right.
buy at the top of the market and you haven't finished your value add yet, and now the lender won't give you your construction draws because you need to pay down money, otherwise they're going to lose more. These things happen, right? And it's understandable, but being able to explain this to a limited partner that comes in that doesn't really understand that, hey, interest rates change so drastically that all markets, all multifamilies, as well as, commercial, retail, and office
Yeah,
space and everything else, that's all 100% geared based off of cash flow, took a hit, and a
yeah,
big hit, especially, in the meantime, right? And so that's a big challenge. And now that we're seeing the most amount of loans coming due, the banks are being very careful, right?
yeah,
They're wanting to say, well, what risk is there of rates going to go up in the future? Let me make sure I'm mitigating that risk too. And they're not getting you the bottom of the dollar interest rates because they're
yeah,
scared of that long-term risk. And they're giving you shorter term financing, which in my eyes is highly risky right now. I personally don't want 5-year even. I want 7-year debt because I'm used to single families and fourplexes that you get 30-year debt on. And I'm like, I can't emotionally do this. It's very difficult, right? So, but that's how this is financed through, Fannie Freddie and, through traditional banks and debt service coverage requirements versus single families is emotional based many times and not cash flow based, right? So you don't
right.
have that, as much of a regulation. It does affect that debt service coverage ratio financing that's available for single families though, too. So that they kind of didn't have in the last downturn in 2008 was that cash flow based debt financing on single family, which is kind of an interesting play now because you're able to get pretty much unlimited financing on single families. You're not limited to 10 Fannie Mae, Freddie Mac loans anymore. Basically, you can
Right.
get a ton of them, which is great. So there became a market for that as well, underwriting the same way as commercial. And so in California, what have you seen over the last like 10 years as far as like rent growth goes, though? Population, all you hear in the media is everybody's leaving California because it's communism. And I, of course, love saying that it's communism, and I just went to Vietnam and I said I came from one communist country back to California, another communist country. So, but, at the end of the day, what did that policy do to the rent growth and, to the general economics of, multifamily real estate in Southern California?
I was actually doing a training session this morning, and I was looking at an old deal that I did in 2012, and the rents back there, this was in Long Beach, and one bedroom apartments, I think, were renting for $600.
Oh,
So, that's what happens over time. I think a one bedroom apartment in that same neighborhood right now is about $1,800. So rents are just about exactly 3 times what they were in
wow.
2012. Pretty incredible rent growth. And so that's what happens. Unfortunately, they make it very difficult to build. They make it very difficult for tenants to move because they've got rent control protections now. And, as enticing as it is as a fundraiser, taking money over to red states, you have to look at the long term and look at deals like that and see what happened here. So the notion that like the ship has sailed on California is ridiculous. I mean, that property that I was looking at, even though cap rates are basically the same as they were in 2012 right now that we've had this reset, the property's still worth 3 times as much money back then, just because the rents are. I see that continuing. We're projected in the LA area to lose some people. Like I think it's like 50,000 people over the next 2 years, but that's out of like 20 million in our metro area. So that doesn't have a statistically significant effect on anything that's happening here from a fundamental level. And when you look at the supply constraint of that, I expect rent growth to come back pretty aggressively. It's been very flat over the last 18 months, 2 years. We haven't had much. And I think that's just because of everything that's going on in the economy. Affordability is a big problem for us here. Wage growth has been an issue. But as inflation might come raging back, and as incomes continue to improve, I expect rent growth to come back. And we're not building the supply that we need to make that happen. So I think it's going to be the same story.
I think some of the biggest opportunities in Southern California come down to adding those additional units, whether that's adding, micro units and splitting up units into two because it'll help affordability. And I really think the lack of affordable housing is really the biggest demand because people cannot afford, $3,500, $4,000, $5,000, $6,000 a month for an apartment, right? And that's really what it costs nowadays in Southern California to live, in a 2-bedroom or something like that, or a 1-bedroom. You're going to be spending a lot of money every single month, and people can't afford that. And so if you're able to go and cut those down, or on the single family side, I've seen a lot of people creating duplexes, creating triplexes out of this, still getting that 30-year fixed rate financing. Now it's a little harder, right? Because there's just not the duplex comps and the triplex comps out there. So you're going to be probably at a much lower loan to value type scenario, but you're able to bump your rents up massively at the same time and create affordable housing, which is in desperate need, right? You're going to get, for a studio place in Orange County in a reasonable area, it's going to be $1,500 to $2,500 a month, right? Depending on where you're at. And, if you do that in Newport Beach, you're going to get $4,000 a month for that thing. You know what I mean? So let alone, and that's micro housing there, right? So you could put tiny houses in your backyard or a shed and an outhouse out there and get $5,000 a month. So, but, that's in certain areas, right? Of course. But, if you look at the opportunity there and the ability, dependent on the city, of being able to add those additional units and still obtain that long-term 30-year fixed rate financing on single families or turning duplexes or converting garages, granted, it can be really the same, pretty expensive to build a secondary dwelling unit on your unit. It's a lot more expensive than you think, unless you're doing some tiny house thing or prefab housing, type scenario, which may have problems with regulations and, getting approvals done, right? Everything has to be energy efficient now, right? Everything needs, a certain rating on your energy efficient, ratio in California, which adds to the cost of construction. Right. But it looks like that seems to be the opportunity. Are you seeing that happen at all on the single family space or multi?
We see it in single family a little bit. It's super popular in multifamily to add ADUs right now. So garage conversions are definitely happening in a big way in some cities. We see tons and tons of them in Long Beach. And that goes actually hand in hand with finding your way through some financing difficulties sometimes. Because if you can add units to your building, like let's say you're in a situation where your loan's going to reset, or it already has, you have to refi at 6%. You're not going to hit a debt coverage ratio with where you are. You could take $300,000 and do a cash in refi, which is no fun. And so if it's your own building, you got to find the cash somewhere. If it's in investor money, you got to do a capital call. Or you can take the same $300,000 and build 2 ADUs in the garages. You can do 2 studios out of 4 garages. Very common layout that we have in some of these buildings here.
And now you can refinance.
You're creating the income necessary to get your refi. You've added value while you've done that. Sometimes as much as 100% ROI on your construction costs. You're taking the same $300,000 that you would have done to just pay down principal, which is no fun, and you're adding to the unit stock, you're adding to your income, and you're adding value to your building. So super popular strategy right now, both as a way to bail yourself out of troubles coming down the way if you're watching your loan resets, and also really popular for investors to get into some of these medium-sized multifamily properties and really add value. And it's helping us with our affordable housing crisis. even with construction costs being where they are, the rent that you can get for these units is so great. And the valuation is still absolutely there, even at whatever, 10 times gross, that, this is penciling. And if you're in the nicer areas, like you were mentioning, like Newport or whatever, the value add you get from probably the same construction dollars, maybe a little bit more for city requirements. It's insane. I mean, Newport, Manhattan, whatever, some of these beach cities, you're looking at a 25 multiple.
What do they go? 2 caps in those areas, or
I just sold a 2.7 cap in Redondo.
Yeah.
So
and Redondo's not Laguna Beach
Redondo's
in Newport.
Cheaper.
So
2 is about right. So if value that income you're creating, building an ADU at a 2 cap, and all of a sudden the numbers are absolutely eye popping, and you're helping the problem too. So
that's insane. That's awesome.
Definitely.
Dude, this has been, great information, I think, for a lot of people looking at investing in California and just kind of seeing things from a different angle, versus, all the hate we get out there from all the people out of state, which I totally understand, but at the same time, we're trying. We're the good guys.
All these guys, and you included, right? You talk all this smack about California to raise funds to go out of state, but everybody still lives in California.
Yeah.
You have to wonder why.
It's okay. I like to show them, being at my mom's house in Palm Springs with my kids, and showing them videos of me at the pool in December when it's 75 degrees outside, and they're freezing in the middle of nowhere in December. So then they tell me go eat your taxes, and that's what I do. So it's part of it. But the sun's shining. At least the sun's shining while I get to eat my taxes.
Worth it.
Well, how do people get a hold of you, Anthony, if they want to learn more about, getting involved in California real estate or knowing more about some of the strategies you deploy out there?
Yeah, absolutely. Feel free to find me on LinkedIn, Anthony Walker with Buckingham Investments. There's lots of Anthony Walkers. You can shoot me an email if you want. I'm at anthony.walker@buckinghaminvestments.com. Or we actually have a great website as well with tons of local market research, video stuff that we put out, all free, just to help people understand kind of what we're doing here locally. And of course, we've got the Phoebe group that meets on the 4th Thursday of every month in Long Beach.
That's awesome. Thank you so much. And if anybody wants our 200-point due diligence checklist, you can go to MathewOwens.com with 1 T in Mathew. Download it. It's what we use when we're investing with different operators and doing homework on different operators out there. So it'll give you a good starting point for some of the due diligence you should do when you are investing in real estate. So thanks so much, Anthony. Really appreciate the time today. And I will talk with you soon, man.
Absolutely. Thanks for having me.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.